All right, let's jump right into this explainer. We're going to take Arlo Technologies, a company in the middle of a massive, rapid transition into software, and run it through the absolute ultimate investment gauntlet. We'll be putting on our expert analyst hats and evaluating Arlo through the incredibly strict frameworks of some true legends, Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll cap the whole thing off with our own discounted cash flow analysis. Let's get to it.
Here's the roadmap for today. First, an Arlo company snapshot. Then, we look through the Warren Buffett lens, followed by the Peter Lynch lens and the Benjamin Graham lens. After that, we'll dive into the DCF and alternative valuations before wrapping it all up with our synthesis and final verdict.
So Part 1, Arlo Technologies Company Snapshot. From hardware to high-margin SaaS.
Now, Arlo has actually pulled off a really incredible transformation lately. They aren't just boxing up and selling security cameras anymore. They've built this highly profitable smart security platform. I mean, we're talking 6 million paid accounts, driving nearly $357 million in annual recurring revenue as of Q1 2026. This subscription-first approach, it's exactly the game changer that finally pushed them into profitability.
Let's establish some baseline vital signs here. Trading under the ticker ARLO right near $12.92, they're carrying a market cap of about $1.4 billion, and they generated over $150 million in Q1 revenue. But the real standout? Look at that pristine balance sheet. They are sitting on $167.5 million in cash against a literally negligible $8.2 million in debt. That's a fortress.
Moving right along to Part 2, the Warren Buffett lens. We're talking moats, management, and owner earnings.
As we all know, Warren Buffett demands an economic moat, and he loves shareholder-friendly management. Surprisingly, Arlo actually delivers on both fronts. Their personalized AI creates incredibly high switching costs, keeping those subscribers totally locked into the ecosystem. And recent multi-million-dollar stock buybacks show that management has immense confidence. Add in a virtually non-existent debt-to-equity ratio of 0.05 and, well, Buffett would be intrigued. But there is a glaring issue: earnings consistency. They literally just reported their first profitable year, so they're totally missing the decades of reliable profits the Oracle of Omaha usually demands.
However, even with that spotty history, Arlo is currently pumping out a seriously attractive 23.32% return on equity. That right there proves their new SaaS model is highly efficient at generating massive returns on shareholder capital.
So, when it comes to valuation, Buffett is all about owner earnings, right? We're approximating that here using a robust trailing free cash flow of $66.9 million for our 2025 base. But because that profitability is just so brand new, Buffett would absolutely demand a massive margin of safety. Discounting those cash flows heavily to account for the unproven history, he'd probably hold out on this one until the price dips much closer to the $10 mark.
Okay, Part 3, the Peter Lynch lens, growth at a reasonable price.
Now, Peter Lynch would be totally fascinated by Arlo's story. I bet he'd categorize them as a classic turnaround that's rapidly evolving into a fast grower. Taking heavy hardware losses and flipping them into a 26.3% year-over-year revenue jump, fueled by almost 30% growth in subscription ARR, that is exactly the kind of momentum Lynch is always hunting for. Best of all, you really aren't overpaying for that momentum. Arlo's PEG ratio, which, just as a refresher, measures price to earnings relative to growth, sits at a mere 0.67. For Lynch, anything under 1.0 is the holy grail. It strongly signals you're paying a bargain price for their current growth trajectory.
But here is exactly where Arlo trips up in the Lynch gauntlet. Insider ownership is just 2.84%. That offers management very little skin in the game. And worse, institutional ownership is a massive 101.64%. We know Lynch loves undiscovered boring stocks that Wall Street is totally ignoring. Because this trade is already so incredibly crowded by the big banks, Lynch would likely label Arlo a cautious hold at current prices, despite that perfect PEG ratio.
Let's shift gears to Part 4, the Benjamin Graham lens, the defensive investor's checklist.
Okay, Graham's approach is uncompromising, old school. While Arlo passes his size and financial condition tests, mostly thanks to that massive net cash position we talked about, it completely fails the rest of his strict defensive investor checklist. There's no historic stability of earnings, 0 dividends being paid out, and a price-to-earnings multiple of 47 that just completely blows past his conservative limits.
And it gets pretty brutal when we run the actual math.
If we plug Arlo's exact earnings per share and book value into Graham's iconic intrinsic value formula, it spits out a fair value of literally just $2.99. Since Graham demands a margin of safety even below that number, yeah, a strict value purist wouldn't touch this stock at $12.92. For Graham, this is a very clear avoid.
Moving on to Part 5, DCF and Alternative Valuations. Let's forecast some future cash flows.
Let's step back into the modern era here and build a base case discounted cash flow model. We're starting with their actual trailing free cash flow of $66.9 million. To mirror their massive subscription momentum, we'll assume a 20% growth rate over the next 5 years, trailing off to a conservative 3% terminal growth rate. Discounting all that back at their weighted average cost of capital, which is 12.74%, our core mathematical fair value comes out to a very bullish $18.50 per share.
Now, of course, we all know cash flow models are highly sensitive to assumptions, but just look at our worst-case sensitivity analysis here. Even if we use a highly punitive 15% discount rate and a sluggish 2% terminal growth, the mathematical fair value still sits at $13.90, meaning it's completely protected above the current $12.92 market price. That's a great sign.
Taking a quick look at some alternative valuation models, the forward PE of 16.69 is actually quite reasonable for a tech turnaround story. A price to free cash flow of 21 is also pretty healthy. Although, I will say, the enterprise value to EBITDA of nearly 59 suggests the market has definitely already baked in a decent premium for their expected future earnings expansion. So keep that in mind.
Finally, Part 6, Synthesis and Final Verdict. Let's bring all these lenses together.
So, where does that leave us? Honestly, we have a really fascinating split decision. Traditional value models like Graham's demand a drastically lower price. Buffett and Lynch, they clearly see the potential, but they demand a wider margin of safety or less institutional crowding, placing Arlo firmly in hold territory. Meanwhile, modern cash flow models and Wall Street analyst consensus are screaming that Arlo is currently undervalued and a strong buy. But before you make your own call, you've really got to weigh two opposing forces. On one hand, you have the unbelievable margin expansion of their SaaS pivot, boasting an 83.5% services margin. But hidden deep in their 10Q filing is a glaring, massive risk. A single customer drives 40% of their total Q1 revenue. Think about that. That is an extreme concentration risk that could literally threaten those beautiful cash flows overnight.
Blending all these insights together, Arlo looks like a cautious buy for growth-oriented investors at $12.92, largely backed by that strong DCF math and a highly successful turnaround story. But for the strict value purist who demands decades of rock-solid stability, it's a hard pass. So, looking at all the data we just went through, at what price does Arlo's recurring revenue actually secure a place in your portfolio?